If you're a personal income taxpayer with a small business, let's start with some good news. For small businesses, Massachusetts follows most federal income tax laws. That's good news because in most cases, you won't have different federal and state business tax rules to figure out and follow. And since many of you small business owners are sole proprietors, easier is probably better. So let's start by defining what we mean by sole proprietor. A sole proprietor is an unincorporated business with one owner who pays personal income tax on profits from the business. If you're that one person in charge of your business, there are a few important items you'll need to familiarize yourself with. Schedule C, estimated tax payments, and self-employment tax. Let's take a quick look at Schedule C. Schedule C is a large part of your Massachusetts income tax return and basically acts as a profit or loss statement for your business. Here's how it works. Start by entering your basic business information, then add up all of your business gross receipts or sales and report them as income. Cost of goods sold and various business-related expenses are calculated and then deducted to arrive at your business's net profit or loss for the tax year. Hopefully, after all your hard work during the year, you'll show a nice profit. Your net profit or loss is then added or subtracted from other non-business income items on your federal and state income tax returns to arrive at your adjusted gross income. And while it's not unusual for a new business to show a loss in its first or second year, you cannot keep having losses year after year. Legally, a loss may only be shown twice within a 5-year period. If you have any questions about specific allowable deductions on your Schedule C, such as the office use of your home or business use of your car, take a look at the IRS's excellent virtual small business workshop resource on their website. Let's discuss how estimated tax payments work. Most of us at one time or another has had a job and had withholding amounts deducted from our paycheck. It's a tax payment system known as pay-as-you-go. Estimated payments work on the same basic principle. This is the way people who are not subject to withholding pay their federal and state income taxes. In their case, business owners pay quarterly estimates based on the profit they earn. For most small businesses, the quarterly estimated payment dates are April 15th, June 15th, September 15th, and January 15th of the following year. Here's how it works. Although income tax returns are not due until April 15th, the majority of the tax we owe needs to be paid in the year we earn the income. On the federal side, the IRS expects 90% of your income tax to be paid in the year you earn it. That means when you file your federal income tax return on April 15th, only 10% or less of your tax for the year should be sent in with your return. Here in Massachusetts, we have a similar expectation, but a different payment ratio of 80%, 20%. Again, that means that at least 80% of your taxes owed must be paid in the year you earn the income. The balance must be paid on or before April 15th when you file your Massachusetts income tax return. It's important to make sure you make estimated payments on the quarterly schedule. It can often be easy to forget in the course of the day-to-day running of your business. So be sure to set up a good reminder system. And here's a very good reason not to forget. If you underpay your required estimated amounts with either the IRS or DOR, you'll have to pay an underpayment penalty. File your Massachusetts income tax return together with Schedule C. Both the DOR and IRS websites have a lot of helpful information about estimated taxes, so take a look if you have detailed questions about your responsibilities. The federal self-employment tax is how all sole proprietors pay their Social Security and Medicare taxes. The tax is paid directly to the federal government on their forms. Self-employment taxes are similar to the Social Security and Medicare taxes withheld from the checks of most wage earners, except that the tax is computed when filing your federal income tax return. As a business, you can deduct the employer equivalent portion of your self-employment tax on your federal income tax form. Again, the IRS website has excellent information on self-employment taxes, as well as a useful virtual small business workshop. Even though sole proprietors are by far the largest group, there are a number of small business owners who are registered as partnerships or corporations. Because corporations have unique rules and regulations and aren't as prevalent, we'll save them for another class and touch on partnerships. A partnership is an arrangement between two or more persons to carry on a trade or business. Each person contributes money, property, labor, or skill, and expects to share in the profits and losses of the business. Partnerships are required to file an annual informational return to report the income, deductions, gains, losses, etc. from its operations, but it does not pay any income tax itself. Instead, the partnership passes through any profits or losses to its partners, depending on their percentage share of the business. Each partner includes his or her share in the partnership's income or loss on his or her federal and Massachusetts tax return. Partners are not considered employees and do not receive W-2 forms. If you're in a partnership together with one or more persons, your year-end Schedule K-1 will state your share of profit or loss from the partnership and the amounts of federal and state tax withheld. This income should be reported on Schedule E with your federal and Massachusetts returns. If you have detailed questions about personal income taxes and being a sole proprietor, be sure to take a look at the IRS or DOR websites for more specific guidance.